And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Yes, that is correct. It is Friday afternoon again already, and Luke Smith is back in the studio.
I'm shocked. I'm not.
Well, you know.
It feels like I'm here every other day.
Yeah, well, here we are. And, of course, Fridays are the best day of the week, aren't they?
Oh, 100%.
Absolutely. Best
Totally.
day of the week. Today, we're going to be talking about the notice of intent and claiming a tax deduction for personal super contributions.
Yes.
This is a topic that we have come back to time and time again, isn't it?
It is, and it's part of a broader conversation we've had around maximising deductions, putting money into super, and we've talked in the past about concessional limits. And we know that new financial year, we're at 32,500. Not 30,000, so we've had a little bit of an increase. It's a life-changing amount of money, said by no one. But this then dovetails into the 30 June contributions that people have been making, because I get this question and confusion about a notice of intent more than just about anything. You do not have to have had this form to the fund by 30 June. We know that money had to be in before 30 June and cleared. You don't have to have this form in before 30 June. I get so many questions about, well, I've put the form in. And then the super fund wrote to me and they said, I can't have a deduction. And I say, have you put the money in? Oh, not yet. So how do you claim a deduction for money that's not there? So let's start with, you've put your money into superannuation. Why do you need a notice of intent? You need a notice of intent fundamentally because any time you put personal cash that has not been directed by your employer, okay, personal cash, into superannuation, the fund will treat it as a tax-free contribution by default. Now, if you intend to claim a deduction, in strolls Mr. Notice of Intent. And he says, hello, what would you like to use me for? I'd like to tell the fund that of X amount of money I've put in, I, as the person that put it in, am going to claim a tax deduction. So you fill out your form. It goes to the fund that you have put your money into. It doesn't go to the ATO. That's the next most frequent question I get is, so I send this to the ATO? No. You send this form to where you sent your money. Money in first, form goes second. Form says, hey, Superfund ABC, Luke's put in 50 grand. Luke is claiming whatever Luke wants to claim. It may be 50 grand, it might be 20 grand. It depends. And that's part of getting good tax advice and planning your concessional limits, your catch-up concessional space, and what you plan to do to minimise your tax. On the form it says, what's gone in? X. How much of X are you claiming? Y. You sign it, send it to the fund. And the fund will receive that and go, oh, Lukey's thrown in 50, he's claiming 50. Right. Our job as the super fund is to then remit 15% of whatever I'm going to claim to the ATO. And then what the super fund will do is the super fund will then send out a communication that says, hey, Luke, thanks for that notice. We've processed that correctly. Here's confirmation of said transaction. Now, I need to keep that correspondence because my accountant will want it, and it's always prudent to give your accountant a copy of the notice of intent just so that your tax return and the super fund's lodgement of your entry meet up in ATO heaven and you get your deduction. So whilst we sort of tongue-in-cheek say this form's important, this form is 100% essential for you claiming a tax deduction, because without this form, as I said earlier, any personal money that comes into super is treated as tax-free, which means no form, no deduction. And I generally say in my office, hey, let's get the money in June, and then the next day let's send the form, because you won't forget. Now, the other question I get all the time is, do I need to send one with every contribution that I make. If you want to do your own head in and you want to put a personal amount in every month and then send in a notice, yes, you do. You can send one in. If you intend to roll over your money or withdraw your money, you need to have the form lodged before you take it out. So let's have a quick example of that. I'm 61. I've sold an investment property. It's July. I need a deduction to lower my capital gains tax. I throw $32,500 into super. I send in the notice of intent. The fund comes back and says, yes, Luke, we've processed that. I've met a condition of release because I'm over 60 and I've retired. I can pull the balance of my super back out and put it in my hot little hand. If you pull the money out of the fund before you lodge the notice, no deduction. So you need to follow the timeline from an admin perspective. But provided you do that, there's no reason that the money needs to stay in the fund in that example. You might have a similar example and extend it out to, well, I'm going to throw 100 grand in because I need a massive deduction because I've got lots of catch-up space. And I can look back 5 years and the balance of my super is under 500, but I'm going to sell a property and I need a big deduction. Money in, notice in, confirmation back, pull the money out. If you're going to start a pension and roll it over, lodge your form, claim your deduction. If you roll it over to a pension before you claim your deduction, you'll miss out. So this form really matters, and it is very, very important. But again, it's only for personal money. It goes to the fund where you've made your contribution. It goes to the fund after the money has gone in. And you don't want to roll over or pull out until things have been processed from an admin perspective and you have confirmation. And as long as you do those things, this form's a piece of cake.
Okay. Now, you've made a clear point that the money goes in first and then the form goes in after the money.
Yes.
You've also said that if you put the money in before the 30th of June, you don't necessarily need to have the form in before the end of June.
Correct.
You can put it in a little bit later.
Correct.
But I assume there's some sort of time frame. Is there a deadline for how long you can delay putting the form in?
Yeah. Now, this is on a fund by fund basis because you need to have it in that financial year or when the super fund has lodged the tax return. If the super fund you're using has lodged the tax return and you send it in after, they can tell you that you've missed out. So again, I wouldn't leave it to chance. And that's why I say to most people, money in, form in. A lot easier when you're dealing with like a self-managed super fund because you've got control over that. But when you're talking about industry funds and retail funds, just understand the strictest interpretation of the rule is the end of the financial year following the year of contributions. So in 2025, 2026, the deadline's 30 June 2027. However, if the funds lodge their tax return, they may not want to amend it and you miss out. So I'd go to your super fund and say, well, does a specific fund have a deadline and adhere to that? Again, assumptions can be very, very expensive. But if you do it right after you put the contribution in, you're fine. You can also, I said before, you can lodge one each time if you want. You could also make 10 contributions during the year and just put one form in at the end. You can do that as well. So just because you make multiple contributions, it's not a mandatory requirement that you send a form for every time.
So if I put in a contribution every month and I've started in July and I can keep doing it for the whole financial year, so long as I have the paperwork done by the end of the financial year or thereabouts, I should be fine.
Totally. You could make a $1,000 contribution every month out of your own cash. At the end of the year, fill out your notice of intent and go, I've put in 12,000, I'm claiming 12,000.
Okay.
You don't need to do 12 forms.
Okay.
But you do, if you wish to roll over or pull out said money, you need to have it lodged before you either start a pension or make a lump sum withdrawal where you meet those conditions of release.
Okay. So we're talking about claiming a tax deduction on the money that you put into your superannuation.
Correct.
If you don't claim a tax deduction, you can still put money in and it's treated differently inside the fund.
Yeah, that's right. Inside the fund, it's then treated as what's called a non-concessional contribution, and that limit is $130,000 a year or $390,000 in one go over a rolling 3-year period. So you always need to start the thought process with, why am I making the contribution? Because that will then determine, am I doing it for a deduction, or am I doing it because I have capital and I want to bolster my super balance before I start a pension or I retire? Do I want a deduction or not? That will then lead you down the road of, do I need this form or not? And as long as you have that clarity, which really is the starting point of all decisions, this form then becomes very easy to execute and very easy to use. It's an ATO regulated form as well, I can say that. Different funds have different versions of that, but there's also, you can Google notice of intent, and there's an ATO regulated form that all funds will accept. If you can't get one from your particular fund, quick Google, they pop up everywhere. You can download it and you know that it'll be accepted and received from just about anywhere. But some funds also have their own version as well. Either work. Again, just talk to your respective provider as to what they prefer.
Luke Smith from Envision Financial is with me in the studio today, and we're talking about the Notice of Intent, a very important document if you're intending to claim a tax deduction for a personal superannuation contribution. Luke Smith from Envision Financial is with me in the studio today. We're talking about claiming a tax deduction for personal superannuation contributions and the very important piece of paper that you need to fill out and send in order to achieve that. It's called a Notice of Intent.
Exactly.
So
exactly
what do we need to remember?
Yeah, so what is it? It's a formal document that notifies the fund of your intention to claim a deduction where you've put your own money in. So you don't need this form if you're salary sacrificing through your employer, because they will claim the deduction for you. Another big one I get is, but if I salary sacrifice, that's before tax, this is after tax. It doesn't matter. It's the same net tax outcome. You're not benefiting or losing anything by doing either option. In the good old days, you could only salary sacrifice. And then in about 2014, I think the government changed the rules and said, look, you can put your own money in, just don't go over the limit. Okay, so it's a document that notifies the fund of your intention. It then tells them to remit the tax. Without it, you don't get a deduction. So really, really important. Money in first, form in second. Okay? ATO regulated form, or check with your fund. They may have a version that says the same sort of stuff. When's it got to be lodged? So it's the earlier of lodging your income tax return for the relevant year or the end of the financial year following the contribution. But again, I would also then check with your fund and say, well, do you have a timeline? Because they need to process their return as well. Assumptions can get expensive. You send the form to the fund. You do not send it to the ATO. I had someone last year, I get it, I'm across it, I'm all good. Have you got the form? Here it is, it's all filled out, great, cool, send it to the fund. They sent it to the ATO. They didn't get a deduction. They were not happy. That was their problem. So if you're diligent and consistent, again, I just put a reminder in your phone. 1st of June, check for contributions, make contribution, lodge notice of intent. The form in its format hasn't changed. So if you found a copy from last year, you can amend some numbers and send that in because it's an ATO regulated form. So you can't really get it wrong. Now, the fund will send you a communication that says, hey, Leon, we've processed that. Thanks very much. Keep that notification. Give it to your accountant and have it. Because if you ever get audited and they ask for proof, that's your proof that it's been processed, so that your tax return and the deduction you've claimed is then the same as the deduction that's been processed by the super fund. All right? So if you just follow those simple steps, remember, I'm putting a contribution in. Why am I doing it? If you've put the contribution in to claim a deduction and you plan on taking the money out, make sure you've lodged the paperwork before you remove the money and before you turn your super into a pension. If you do that and you haven't lodged the notice, you will not get the deduction, and the fund will not let you go back and lodge a notice of intent for an account that is no longer there. So follow the bouncing ball, be diligent, be accurate, keep your records tidy, and you will get a tax deduction, and everybody loves a tax deduction.
Fantastic. And now I must ask the most important question, Luke. Where can listeners get more information?
Okay, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. And we've got Envision Financial Canberra on YouTube. So you've got a back library there of all of our shows. And we've got Smart Money Strategy, your ultimate guide to financial planning. Well, there's a whole chapter on it, and I even circle it. And anyone that's been in my office, I open the book, circle that page and underline, you must send to the fund. You cannot miss it.
Sensational. Luke, thanks very much. We'll catch you next week.
See you next week.
Luke Smith from Envision Financial, back again next Friday afternoon.